Hey, what's up YouTube? This is Leo with DRIPCalc, and in this video I want to talk about YieldMax funds and why I no longer want to invest in them and what my strategy will be going forward. Okay, so basically we're 3 days from the announcement of YieldMax and YMAG distributions. I made a video about that a couple days ago, and so I want to look at the overall picture, how we're doing. And so if you look over here, pretty much all YieldMax funds except for 3 are in the red on the price. So this column right here, they're all in the red. However, some of them are still in the green because of the dividends they've paid so far, and NVDY and Misty are actually in the green on the price. And then we have Fiat, which is the short of Coinbase. That's also slightly in the green, but basically at break even. And I think Coinbase will go up in the near term, and Fiat will start losing money, will turn red. So anyway, and the Coinbase is the one I want to talk about. So let's take a look at this. So Coinbase is very volatile stock, and you can see here, like on July 11th it was $214, and then in like 11 days it was $265. So that's $50 move in like 10 days, and $50 move is like almost 25% in 10 days, in 11 days. So less than 2 weeks you have 25% move. And then from 265 it was a violent move down to below 180. And so yeah, and nobody was immune to this move. Like almost all stocks crashed on Monday of last week. Okay, so, and even before that it was moving down. Now, so we cannot predict the movement of the stock. However, I am really unhappy with the way that CONY manager, which is a ETF from YieldMax that sells weekly calls on it. So let me show you their trades, or their trades for just this month alone. So from August 1st until basically last Friday, or this Friday. So in this month, I'll just go quickly over the end results. They have lost a combined of $106 million. That's an actual loss that they took after all the covered calls and everything. And at current net asset of the fund, $620 million, that's a 17% loss compared to the current net asset value of the fund. Okay, and we can go, so here, these are the daily trades. In yellow, I basically put the synthetic positions. So they had a really out of the money synthetic position expiring on August 16th. That was a $250 strike. And so over here you can see the trade. They bought back the call, the synthetic call, for $3. They sold it for much more before that, but then they had to buy back the put, and on that they lost almost $65 million, because they had to pay $40.50 per share, and that's 100 shares per contract. You multiply that by 16,000 contracts, and that's a $65 million loss. And the reason why the put was so expensive is because the closing price of coin on that day was $212. And again, they're obligated to buy shares 16,000 times 100, so 1,600,000 shares at $250, when the share price is at $212. So they have a $65 million loss. Then they closed another position, and this is them opening another position right here. So they moved it down to 210, and it now expires on September 20th. And so over here you can see they bought the call for 210, and they spent $38 million, and they sold the put for $33 million. So they lost another $5 million just on that thing alone, even though it's like out of the money. So whatever. Here's a smaller position, the same thing. They spend more than they get anyway. So this day, and then they sold weekly calls, and basically the damage for that day alone was $60 million. I'm not gonna go over all these trade dates. However, this is what I'm unhappy about. Okay, so they have a synthetic position now. It's all $210, expiring in a month and a half from now. So we have some time for coin to recover and maybe make some money. Okay, sure. But over here, so these are the last 3 days of last week. The Black Monday thing already passed. The market's recovered, and even the Coinbase, if we go back over here, so it bottomed out at 178, 179, and now it's like 195. Okay, so we recovered. So now they already kind of dealt with their synthetic positions. They bit the bullet, lost a bunch of money. So now let's sell weekly calls. Now we make money. Okay, so here on Thursday we made $6 million. But look at this. They sold the call for $207.50, and so that's how much they got per share. Multiply times 100. That's one contract. times 750, that's how much they made. They made $261,000. Okay, and now the break-even price is $211 essentially. So if the price of CONY, of Coinbase, moves up above $211, we're losing money again. However, because our synthetic kind of protects our bottom line, if Coinbase breaks out and just goes up like crazy, that's 210. The net dollar amount we can capture is $1 per share because our synthetic position is 210. So okay, this is quite all right. But then look at this one. They sell a 210 call and $202 and $250. So now the break even is 206. And now if the Coinbase goes above this amount, 206, but below 210, we still lose money, and there is a very high probability that it will go. Okay, so they sell another call on that day, and that's for 207.50. And now we're slightly above our synthetic and whatever. Okay, so we move back on the 7th of August. They sell a $200 call expiring. These are all expiring on August 16th. Okay, so 200 call, break even under 204, so that's way below our synthetic position, and the probability that coin will move up is pretty high. Okay, now granted, the price of Coinbase on that day was very low, and so like even that was a pretty high premium. They're yielding 93% over here, 94%. Like, that's crazy, guys. Go up a little bit, go above your synthetic, go to 210. You will make a little bit less money, but at least you won't lose money. You won't end up losing 17% of your net asset value in basically like 9 trading days. That's insane. Like, why do we need 96? Like, yeah, I want higher returns, but I'm okay with 60% and not losing money, because the reason they got into this position, into having a 250 call, 250 synthetic, actually that all dates back to April of this year, when they were greedy and they wanted to maximize the yield instead of like going a little more conservative and not getting burnt on the synthetic. And once that started, every time the coin runs up, they have to roll their position because their weekly calls are way too in the money, so they have to settle on a very high synthetic position. So 260, 250, it's a roller coaster. And then Coinbase drops and they lose money on their synthetic. And so the amount of money they make on the weekly calls is not enough to cover the massive losses they take every time that Coinbase does one of these things. So if we go back to April, here's when they sell the synthetic position somewhere over here into May 17th. And what happens to Coinbase? It drops. I mean, I don't even remember the exact date, but they sold it pretty high. And then after earnings, Coinbase dropped to like below $200, and they have to recreate the synthetic position on May 17th right here. And so they're underwater by about $30-40 over here. So they recreated, and basically that roller coaster, every time they get caught with the synthetic position at the peak, and they have to roll it every time when it goes down. And that's why we end up with all these things. And half of that could be avoided by just going a little bit further out of the money on the weekly calls, guys. Like, you don't need to yield 103%. Yield 60%, but instead of 202, go to like 210. Go higher than 210. And I'll show you. So right here, this is the last trading day. So they sold a 202 call. Okay, so let me show you the options. Now, the Coinbase actually recovered in price a little bit. They sold it for 210, and it closed at, they sold it at $4.10 over here. So that's how much they got per contract, and it went up to $4.95. That's okay. They could have sold a $210 position, and they would get about $220 for that. Now let's plug $220 over here, but we change this to $210. Okay, so now they're only yielding 54%. OMG, that's such a bad yield, But now they're protected from Coinbase running up, which is very likely at this point. So let's undo this. And the same thing over here. They sell really close in the money, and then when Coinbase runs, they'll have to they'll have to do a bailout on the synthetic side. So they'll have to move their synthetic up again, and then when Coinbase drops, they make this massive losses of like 20 million a day, 60 million a day. And these daily gains, they do not cover the losses on the synthetic. and all they had to do was move the synthetic price or the weekly call price up a little bit, just to yield a little bit less but be a lot more safe. Because once the price of Coinbase moves above the break even, we have to buy those options back, and that costs us money. Okay, so I'm really basically unhappy with how the manager of CONY is trying to maximize the yield. Yes, it's in their name, max yield, but I think 54% is enough of max yield to make most people happy and not lose their money, you know. Like, look at this, look at the Bollinger Band. So this is Coinbase going back year to date. Okay, so we're way below our 200-day moving average, 50-day moving average, and even the 10-day moving average. We're below all of them. But you can see when we hit the bottom of the Bollinger Band, so the share price usually wants to come back to the middle of the Bollinger Band, and that's where it usually settles most of the time, unless there's like some big movements in the market. So over here, the price crashed because we had, you know, a black swan event sort of, with the yen carry trade and the Nikkei, which is the Japanese index, stock index, that dropped like 20% in 2 days. On one day it dropped 13.5%. And since it has recovered for the most part, but you know, a lot of American stocks also took a dive, especially risks and the volatile stocks like Coinbase. But you can see that price usually wants to go back to the middle of the Bollinger Band. And the RSI over here was like the lowest RSI we had all this year. So selling such close to the money weekly calls, when you know that most likely the price of coin will recover, most likely will go back to the middle of the Bollinger Band, where right now it's about 220. Okay, and you can see over here, if the price moves to 220, let's take this one, we basically lose $13.40 per share, and then we have to execute our or use our synthetic position, so we lose $3.30 on every share, because this covers the synthetic, it covers us in case that price of Coinbase skyrockets. But this limits our upward potential because they decided to yield 103%. Again, had they yielded like, you know, 110, had they sold the 110 call, they would be way out of the money, and they would make less money, but then we would be much more protected in case of Coinbase going up like a rocket ship. And at this point, I think it will. I think it will go to 220 this week. Now, again, there could be like anything in the market. The Bitcoin may dump to $45,000 again. And yeah, then in that case, Coinbase will drop. But at least be more safe. You know, we don't need to yield 103%. Yield 60%. Most people will be happy with that. And you remove the downside risk. Like, nobody can protect you from Coinbase moving to $100. Okay, fine. But if it violently moves up, we lose money if it moves up. Like, how is that possible? Because the manager is greedy. And that's why I am no longer investing in YieldMax. I think the managers, because it's not their money they're losing, they don't care. Yes, they want to produce the results, so more people buy into the funds, and people have been moving out of the funds. Now, I'm not selling my position, but I am not reinvesting any more dividends. I'm just collecting them, and we'll see what happens. And my dividends, or my money in general, I will use in a different way. So let me show you how. So one of the stocks, and I talked about it in my previous video on the YieldMax and YMAG estimates, dividend estimates. So I want to own Robinhood, so ticker Hood, and this is the way how I can make my shares of Robinhood yield me income while I still hold my shares. So, for example, you can buy Robinhood for about $17.85 right now. Well, not right now because markets are closed, but on Friday at the end of the trading day, you could buy it for that price, and you could sell a covered call for your shares. Let's say you sell a $19 covered call 1 month, less than 1 month out. It's September 6th. You would collect 80 cents per share. Okay, so let's just quickly calculate it. We'll start with new sheet. I can't. I've been in the US for 20 some years. I can't pronounce that word, guys. Yeah, excuse my my Russian French. So $17.85. Okay, and for less than 1 month, let's call it 1 month, we would make 80 cents per share. Okay, so that is, we divide 80 cents by the share price and multiply by 12, and that is, we change this to percentage, let's sorry for taking this sweet time. That basically yields you 54% per year, even probably more because this is less than a month. And then the strike price over here is $19. So if you're forced to sell, if you're assigned on your options, let's see how much you make. Okay, actually no, I'm wrong. So this is your cost, because you already collected 80 cents per share. So now your cost basis is $17. And let's say you're assigned at 19, you're making nope. So you're earning basically 14%, on 11.4% in 1 month on your money, if you get assigned. And if not, you're yielding 53% or 54% in 1 month, like annual return. And then when those options expire, you can sell another call and another call and another call, and your cost basis reduces every time you sell a covered call. Now let's take a look at Robinhood. Right here. So here's Robinhood, Bollinger Band, Robinhood 3 months. We can go year to date, but the same picture. When it goes to the bottom of the Bollinger Band, it wants to go back, and when it goes to the top of the Bollinger Band, it wants to go back down. Okay, so here we were sitting at the bottom of the Bollinger Band, one of the lowest, or if not the lowest RSI of the year, and we're still kind of at the bottom of the Bollinger Band, and the RSI is basically at lowest levels. So you can see this line here, right here. You can see current RSI when it closed was what was it, 42, and it's excluding this past week, it's basically the lowest RSI of the year. And it's because the Bollinger Band widened so much, it seems like the price of Robinhood is not sitting all the way at the bottom. But if you go 1 year, same picture, let's go 3 months, like, yeah, it doesn't look like it's sitting at the bottom, but look how wide it is, how far it is from the opposite end. And so most likely, now nothing is guaranteed, but most likely price of Robinhood will go to the $20 range in the near term. And so I feel like it's a pretty safe investment. And they had an amazing quarter results, and I think they'll have even better quarter in the upcoming earnings release. And also, so they've added $13 billion in assets under custody. And just on the Monday, when everything dropped, they added $500 million in 1 day. And if you basically in 1 day, guys, it took them 3 months to add 13 billion. Okay, and just on Monday they added $500 million. Part of it because like all the big trading platforms like Schwab, Vanguard, Fidelity, M1, they were all unavailable, and people are like, screw this, I'm going to Robinhood because it actually works. But whatever, there is a lot of hatred to Robinhood because of what happened during the meme stocks when they removed the buy button. You know, the GME, GameStop, and the other meme stocks in 2021. But whatever, at this point it's a much different company, and they're actually growing. So look at this earnings report, guys. So sure, this looks pretty bad, but this was mostly like goodwill losses. They are killing it on the earnings. They're profitable. They have amazing balance sheet, basically no debt, and their revenue is growing by 40% a year. Like, it is an amazing company. They have a very bright future. Look at the net income. Yes, over here it was pretty bad, and that's why this whole graph looks pretty bad, and it will take a bunch of quarters, few years, like 3-4 years, to clear it and make it look a lot prettier because of all this negativity over here. But at this point, they're making money. They're making a lot of money. They're growing assets under custody. They have a lot of things going for them. They're eating Coinbase's launch as far as retail crypto, and I think this stock is really good. Now, I'm not telling you to buy it, but you know, they're actually starting buybacks, and they have even the estimates from the analysts now. I don't think they have been updated in a while, but look at the 26 estimates there. Have a really bright future ahead of them. They have positive net profit margin. They have insane gross margins, and I feel like they're pretty cheap right now, especially that they were trading at $24 just couple of weeks ago. Over here, July 15th, they were trading at 24, and now they're trading below 18. So I think it's a great stock to invest in, at least for myself. I'm not telling you to invest in it. And then Palantir, another one of those stocks that I am first of all invested in it. But even if you just do the wheel and sell your own covered calls, so again, we're looking at a September expiration. If you buy it for $30, you can collect 73 cents per share. So that puts your that makes your cost basis $29.27, give or take. And then if you're assigned at $33, you make another 10% on the top, okay? And then you can rinse and repeat. You can also sell covered pools, cash secured puts, but that's a whole different story. I want to make a separate video about that. But what the whole point is that instead of relying on the greedy CONY manager that tries to yield more just to, to show the investors, hey, look how good I am, and then he ends up losing a lot of money for the investors, I would rather, blame myself for the losses. Let's put it that way. And by the way, so far, I don't have anything to blame myself for, because my cost basis on Palantir is $21, and that's before any covered calls and puts that I have collected, any premiums that I have collected. And with the premiums, I think I'm seeing at like $17. And I have been buying ever since the $14 mark. Before that, I was shorting it, and then at some point, I'm like, I'm just going to keep losing money on shorting it. This stock is going up and to the right. And so I switched my whole mentality about Palantir. I did a lot more research into the company, and now I switched from a bear to a bull. I think they have a great future ahead of them. Now, I think in the near term, the price will actually come down, and it is a very volatile stock. Like on the Black Monday on August 5th, it crashed to like below $21. And so even if you take stock like MO Ultra, it only crashed to 47.5. So the loss was like less than 10%, whereas this thing crashed by 25-30%. So yeah, if you look at this chart, so before the earnings, Palantir was sitting at 27, and then if you look at 1 week chart, so this was not even the bottom. They didn't record the bottom over here, so it was $20.60, 60 some cents. So that's a pretty huge drop from 27. And but then it quickly recovered. And if we look at Ultra, like it started at 51 and it dropped 7.5%, give or take. So Ultra is a lot more stable stock, because basically what's going to happen to it, they sell cigarettes. We already know how much they sell, more or less. Like the variance is pretty small. But Palantir, people were unsure. So what I'm saying is there will be a lot of volatility in Palantir stock. Like if we look at year to date, they had amazing earnings over here, but the stock crashed to $21 range because somebody didn't think it was good enough, But now Palantir is doing amazingly. Look at it; they're growing at 27% top line. They had amazing revenue growth. So if you can look over here, so top line 27%, that's year on year, and I think they'll have amazing top line going forward. They're printing money. They're sitting on $4 billion in cash and basically almost no debt. I don't even know why they have 200 million of debt if they have so much cash, but I guess their debt is cheaper to carry than the amount of interest they get on their cash. So probably that's why they're doing it. Their EPS right here is growing at, we can't compare it, but basically it's growing nicely. And this is GAAP EPS. Non-GAAP was 9 cents. So this company needs a separate series of videos because it's so great. And again, because it's a relatively volatile stock, first of all, you can take advantages of when the stock drops significantly. Like I actually bought call options over here, and I bought call options more than a year ago. And I usually buy in the money call options, and I'll talk about that separately. But what I'm saying is that most likely it will go below $30 in the near term, so you can secure a better cost basis. However, you can still collect pretty decent premium on the covered calls. And so just compare this to Ultra. For example, you buy this for $30 right now, you sell a $33 call. So if you get assigned, you collect that 10% premium between your cost basis and how much you sold, plus the 73 cents per share. That itself is like 2.5%. So your total gain is like 12.5% in less than a month. Now, Ultra share cost more. It's like $50 right now, and they'll actually increase their dividends. I don't know if they made an announcement yet. I want to make a video about that, but they'll pay you at this point 98 cents per every 3 months, or about 33 cents per month, so you already make a lot more money in the covered calls compared to OCHE, which is like a very high yield regular stock. And this is, you multiply this by 3, that's like $2.10, and you make more than 100% extra in call income, and then you also protect your upside, and you reduce your cost basis on a really quality stock. If you get assigned, you can always sell put option to get back into the stock, and if you don't, you basically keep the premium. That's called wheeling. So I'll make a separate video on that, but bottom line, I will not be in the YieldMax, and I will not be buying any more of YieldMax. I will hold my shares for now. If I see the opportunity to get out, I will do that. But overall, the way that managers run this business, I am pretty unhappy. Yes, sure, it's not their fault that the whole market crashed, but they have the control of their positioning, and I don't think they're doing a good enough job with the investors' money. So that's just my opinion. You guys let me know what your opinion is in the comment section below. And thanks for watching. Smash that like button, subscribe to the video. I know this was long, but I hope you enjoyed, and I'll see you in the next video. Bye.